Get your free copy of the complete tutorial at www.teachucomp.com/free.
The profitability ratios give an indication of the ability of a business to make a profit. There are quite a few ratios that can be used to measure a company's profitability. We will look at the sales growth ratio, the cost of goods sold to sales ratio, the gross profit margin ratio, the net profit margin ratio, and the return on equity ratio. The sales growth ratio shows a percentage increase or decrease in sales between any two time periods. It is common for the time period used to be a year. However, you can use any period, such as a month or a quarter, if you want. To calculate the sales growth ratio, subtract the past period's sales from the current period's sales, and divide that number by the past period's sales. In this case, you are looking for a steadily increasing ratio percentage over consecutive fiscal periods. This indicates a steady increase in sales. The cost of goods sold to sales ratio shows what percentage of sales is used to pay for inventory expenses. To calculate this figure, take the value of the cost of goods sold expenses and divide it by the value of the sales. You are looking for a stable percentage value across consecutive fiscal periods. This indicates that the company is controlling its gross margin. The gross profit margin ratio indicates how well a company manages its materials and labor costs in the sales process. It shows the percentage of net sales remaining after subtracting cost of goods sold. This ratio does not take into consideration overhead costs. To calculate this ratio, subtract the value of the cost of goods sold expense accounts from the gross sales to arrive at the gross profit. Then divide the gross profit figure by the value of total sales. You use this ratio by comparing it to the average or common gross profit margins in your industry. Examine this number from month to month to see if it stays the same, improves by getting bigger, or deteriorates by getting smaller. The net profit margin ratio shows how much profit is left from the gross sales after removing the cost of goods sold and all other expenses except taxes. To calculate this ratio, divide the pre-tax net profit by the total net sales. You use this ratio in the same way that you use the gross profit margin ratio. Compare your company's ratio to industry standards and look at the trend from month to month to see how well you are managing your overhead costs. The return on equity ratio, also called the return on investment ratio, or ROI for short, shows the percentage of return on funds invested in the business by its owners. As an owner or shareholder in a business, this important ratio shows if you are making enough profit being in business. To find this ratio, divide the net profit by the equity.
Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.